Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. Please note that the views shared here are not personalized financial advice and are for informational purposes only. Always consult with a financial professional before making any investment decisions. Now let's dive in. If we had to pick one word, just one, to describe today's market, it would have to be reversal. I mean, it was a massive, violent reversal.
It really was.
We started the day with so much optimism, things looked great, and then it just completely fell apart. A total U-turn that unwound days of gains in just a few hours.
The sentiment shift was incredibly dramatic, and the numbers, they really paint the picture of just how extreme it got. We saw the major indices rally up to 2% at their highs, only to close sharply lower.
So let's get into those numbers. Just how big was this swing?
Well, let's take the S&P 500. It closed down 1.56% at 6,538.76. But, when you remember that it was up nearly 2% this morning,
Right.
You realize that's a 3.5 percentage point swing from the peak of the day to the close.
That's a huge move for the S&P. It tells you everything about the psychology just vanishing midday.
It was even more stark in the Dow. The Dow plunged 386 points by the bell. But, and this is the crazy part, it was up over 700 points earlier.
So you're talking about an intraday swing of over 1,000 points.
Over 1,100 points, yeah. Think about that. An 1,100-point round trip, that just screams a complete lack of conviction in any direction.
And I assume the NASDAQ, being more volatile, was even worse.
Oh, absolutely. The NASDAQ dropped 2.16% for the day, after being up as much as 2.6%. That's a swing of nearly 5 percentage points.
Okay, so when you see that kind of violent repricing everywhere, you have to ask the big question, why? We had what looked like two pieces of really good news. It just feels so counterintuitive.
It is. And it's the return of a dynamic that I think a lot of us hoped we were past. Good news is bad news.
Ah, the Fed narrative.
Exactly. In this kind of interest rate environment, any strong economic data is immediately seen through the lens of what the Federal Reserve will do. The logic is, if the economy is too strong, the Fed has absolutely no reason to cut rates.
Right. Or worse, they keep them restrictive for even longer.
Yeah.
And that's just toxic for valuations.
It is. And we saw two specific catalysts that triggered that exact mindset today. The first was NVIDIA's earnings.
Which were, by all accounts, a blockbuster.
A total blockbuster. Q3 earnings per share beat, revenue beat by nearly $2 billion. Their data center revenue it crushed all the estimates.
Okay, so a market leader, a bellwether, posts a huge beat. Normally that supports the market. What happened?
Well, initially it did. The stock rallied about 5%, just like you'd expect, but then it completely reversed course and closed down 3%.
An 8 percentage point swing.
In NVIDIA.
In NVIDIA, a stock that represents so much of the market's recent narrative. It just epitomizes this deep skepticism right now about AI valuations. Investors are clearly saying growth at any cost is over.
And the second catalyst. The second was the delayed September jobs report. The headline number looked really good. 119,000 jobs added.
Which is way above consensus, right? I think it was 50,000.
Way above. So on the surface, that's strong job creation. But the market's reaction wasn't celebration. It immediately started digging under the hood.
And that really gets to the core of the struggle right now, doesn't it? It feels like the market is caught in this no man's land. Is the data strong enough that the Fed won't cut? Or is it actually weak enough under the surface to be signaling a recession?
That's the paralysis, the internal contradiction. And that look beneath the jobs headline only made the worries worse today.
So what did they find under there?
Well, while the headline job number was good, other parts of the report showed some significant deterioration. The big one was the unemployment rate. It climbed to 4.4%.
Which is still historically low, but
it's the highest level we've seen since October of 2021. That's a nearly 4-year high. And analysts are really focused on the rate of change, and that rate is starting to get concerning.
So a very mixed message. Good job creation today, but the overall trend is pointing towards some long-term weakness building up.
Precisely. And the revisions made things even spookier. July's payrolls. They were revised from a gain of 22,000 to an actual net loss of 4,000 jobs.
Oof. Going from a gain to a loss, even in revision, changes the whole story.
It changes the momentum. And we saw losses in key cyclical sectors, too. Manufacturing lost 6,000 jobs. Transportation and warehousing lost over 25,000. Those are often the canaries in the coal mine for slowing demand.
It's just a very muddy picture, and all this feeds directly into the enormous uncertainty around Fed policy.
It's causing what some are calling Fed paralysis. Just look at the rate cut expectations. A month ago, a December rate cut was a 99% certainty.
And today?
Today, that probability has just collapsed. It's down to maybe 22 to 32%. That is one of the fastest, most violent repricings in the futures market we've seen in a long time.
And we also got the FOMC minutes yesterday, which didn't exactly help with clarity.
No, they revealed, unprecedented divisions. You had several members arguing against the last cut, and many saying they favor no more cuts through all of 2025.
That's a very divided committee.
Very. And then you add in this data fog issue. Because of the recent government shutdown, the Fed won't have the complete October economic data before their December meeting. They're basically flying blind into a huge decision.
So one way to think about this is that the policymakers are just stuck.
Yeah.
They're caught between their mandate to fight inflation, which is still near 3%, and then these signs of a deteriorating labor market.
Right.
And they have to make a call without all the facts.
And that translates directly into market paralysis and these huge violent swings we saw today.
Did this show up in other asset classes, or was this just an equity story?
Oh, no, it was everywhere. We saw some really significant dislocations in traditional relationships.
Okay, like what?
Well, take the bond market. The 10-year Treasury yield, it fell a bit, down 3 basis points to 4.098%. But with equities selling off that hard, you'd normally expect a massive flight to safety, pushing yields way down.
But it barely moved.
Barely. It suggests that while there was a risk-off move, those nagging inflation fears and the Fed uncertainty kept a floor under yields.
Interesting. And what about the dollar and gold, that classic inverse relationship?
That broke down too. The Fed narrative won. Gold actually fell today, down 0.37%, even though the dollar was slightly weaker.
So gold traders are more worried about fewer rate cuts than they are about a weaker dollar right now.
That's exactly it. If the Fed is less likely to cut, the appeal of holding a non-yielding asset like gold just goes down.
Okay, that makes sense. But what about the credit markets? You always say they're the canary in the coal mine. What are they signaling?
They are flashing a pretty serious warning sign. Credit markets are pricing in dramatically higher risk. We're talking about investment-grade corporate bond spreads.
The extra yield you get for holding corporate debt instead of treasuries.
Exactly. That spread has widened significantly. We've seen a 60% increase in just 3 weeks. It's gone from around 75 basis points to about 120.
A 60% jump in 3 weeks is intense. But we're not seeing a wave of defaults, are we?
And that's the key point. This is happening absent a wave of defaults. It's a forward-looking move. Credit investors, who are usually more cautious than equity investors, are demanding more compensation for the risk that earnings will weaken down the road. They are anticipating trouble.
That's a serious signal. Let's pivot to crypto. It often acts like a high-beta tech stock, so I'm guessing it had a rough day.
It did. Bitcoin plunged to $88,522. That's its lowest level in 7 months. It tracked all that weakness in unprofitable tech pretty closely.
But I saw something about the ETF flows. Did they finally turn positive?
They did, for the first time in a week. After 6 straight days of outflows totaling almost $3 billion, we saw $240 million of inflows into the Bitcoin ETFs today.
Is that a meaningful shift?
You know, it's a small data point. It could suggest some institutional investors are stepping in to buy this dip, but it's way too early to call it a trend reversal, especially with volatility in Bitcoin now exceeding 80% annualized.
Wow. Okay, back in equities, let's talk sectors. You mentioned NVIDIA. It really feels like we're in the middle of a serious AI valuation reckoning.
The reckoning is accelerating. Even with NVIDIA's amazing numbers, the market just immediately started to question the valuation. And that 8-point reversal in NVIDIA was followed by deep, deep red across the whole semiconductor space.
Like who?
Western Digital, Micron, both plunged 9%. It was a bloodbath for the chip makers and infrastructure plays.
So the market seems to be shifting away from that AI at any price narrative that's dominated for so long.
Exactly. The focus is now on demanding concrete returns on all this massive capital spending. The question has become, when do these billions in AI investments actually translate to profits for everyone else, not just the chip makers?
And this tech weakness was in really sharp contrast to what we saw in the consumer space, right?
Yeah.
It feels like that K-shaped economy story is just getting stronger.
It is undeniable. The bifurcation is so clear. Look at Walmart today. It's surged over 6% on really strong earnings. And the CEO specifically called out strength especially with higher income households.
But that's not the story everywhere in retail.
Not at all. It's the complete opposite of what we've been hearing from, Home Depot and Target. They keep highlighting the pressure on their lower income customers who are still getting squeezed.
It makes it so hard to get a clean read on the economy when the consumer is so split.
It does. Just a quick note on real estate. Amidst all the carnage, it actually held up pretty well.
Really?
Yeah, the main real estate ETF, VNQ, was up a bit. It suggests maybe investors are seeing a floor in property values, especially with mortgage rates holding steady around 6.26%.
But demand is still weak, I take it.
Oh yeah, demand is still very subdued. Properties are sitting on the market for a median of 49 days. That's the longest it's taken to sell a house at this time of year since 2019.
Okay. So looking ahead, especially with the short Thanksgiving week coming up, what are the key things you think we need to be watching?
I think there are three really big, unresolved questions that are going to define the next few weeks.
All right, what are they?
First is just the Fed policy path. What do they do in December with incomplete data and a divided committee? A hold. A surprise cut. Their guidance is going to be everything.
Okay, number 2.
Second, the AI infrastructure returns. Does this valuation repricing continue? Or can these companies start to show the returns to justify these massive valuations? The market is now in show me the money mode.
Makes sense.
And the third.
And third, the credit market signaling. Does that 60% widening in credit spreads actually predict an earnings slowdown like it has in the past? Or was it just a brief overreaction? That's a huge question for the market. Those are definitely the core issues. So as we wrap up, leave us with one final provocative thought after a day like today.
Well, a day with an 1,100-point reversal on the Dow, with the VIX fear gauge up near 24. It tells you that algorithms and systematic strategies are really amplifying these moves.
Yeah, machines are in control.
They're reacting instantly and magnifying the uncertainty. And when you look at something like the Crypto Fear and Greed Index, which is at extreme fear, you can read this volatility two ways.
Okay.
It could be the final, painful washout, a capitulation that sets up a bounce, or it could be the start of even more systematic volatility as key technical levels start to break. The main takeaway is that uncertainty today doesn't just mean down, it means wild, amplified swings in both directions.
That's all for today's episode of the Daily Consolidation. If you enjoyed our analysis, remember to like this video and subscribe to our channel for more daily market briefings. See you at the next close.